Hello everyone. The month of June 2018 for the bond markets could be best described as a roller coaster ride. Now, why I say this is because we started the month with the 10-year benchmark bond yield starting at about 7.8 to 7.82. We had the monetary policy on June 6th, post which the yields actually went to an intraday high of 8.03, and towards the month end the yields almost, I would say, settled at around 7.9. The gyrations that witnessed across not only the 10-year benchmark bond yield but also the short end of the yield curve in response to tight liquidity, and also the far end, which is the 25 and 30-year government security segment. Therefore, I said it's at best described as a roller coaster journey. Now, what really triggered these events? I would say quite a bit of it is attributed to crude oil prices. We saw a rise of almost 2.3% jump in crude oil prices. In fact, I'm tempted to say that the oil motto is very similar to the Olympic motto, which says faster, higher, stronger. So therefore, that's one key deterrent. Second is that globally things are far from settling. The dollar as a currency is gaining momentum, which is visible in I would say, depreciation of most Asian currencies, including the INR. So I think it's a combination of each of these factors, and more importantly, lack of buying appetite from domestic institution investors as also foreign institutional investors, which has led to this kind of a scenario. As we speak, calendar year to date, the total FPI outflows out of Indian bond markets is approximately 39,000 crores. Now that clearly is acting as a potential demand dampener over and above the fact that entities like public sector banks in India are conspicuous by their absence. What therefore could be the way forward for bond markets? Now, as we mentioned and as we have been quoting this for fairly long time, that the interest rate scenario in India will continue to remain at elevated levels. We have already seen one rate hike in this financial year 2019. We are not of the view that this could be a continued or a prolonged rate hike kind of a scenario, but it does not mean that this could be the only rate hike for financial year 2019, which means that there could be alternating between a pause and a rate hike depending on how the incremental macro data unfolds. The next policy decision will be in the month of August. Till then, we will have some reasonable indication on how the monsoons in India are progressing, and more importantly, how crude oil trajectory will pan out over the next 30 to 45 days. Additionally, one needs to bear in mind that if there were to be indications of a trade war, which is, which we will come to know obviously in the course of the next few weeks, that could be bond market positive, because typically in this kind of a scenario, there is global rush to safe haven, which usually means the US treasuries, which are a deemed safe haven harbor, tend to start finding a lot of support. So I think global yields softening, if at all in the interim, could be a near-term silver lining for our bond markets. But I think till then, I'm reminded of this song called Free Falling by Tom Petty, which is obviously reminiscent of both the bond yields as also the Indian rupee. What should investors do in this kind of a market scenario? So usually we've seen that rising interest rate scenario or maybe elevated yield scenario are a best suited condition for fixed maturity plans to flourish. and intuitively so if you see the month-on-month collections as an industry in this category seems to be growing. These are categories where investors can actually lock in line with the maturity of the scheme, which means while you are compromising on liquidity, you certainly are mitigating the interest rate risk to a large extent. So clearly that could be one suggested way forward. And of course, no marks for guessing, our cliched favorite category, which is the credit risk funds, where we believe a lower duration. Again, there is no hard and cast duration defined, but typically these funds have been in the band of 1 to 2 years of duration, could be the way forward because elevated yields also translate into elevated portfolio average YTMs, and therefore it could be a less volatile and a slightly more stable ride on your fixed income investing. In conclusion, we believe, as reiterated earlier on, that India does not seem to have embarked on a rate tightening spree, at best a shallow rate hike kind of a scenario, which means that one, at max two rate hikes seem to be the port of call right now. The bond markets have substantively discounted quite a bit of these events, which is reflected in the high yield levels in the market. It would be useful to participate alongside this elevated yield curve journey. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.